Good morning, everyone. Thank you for joining us today. Just waiting for a few more people to join, but I appreciate you joining us on a 10:30 a.m. session. Really crucial time in the year, mid-February. It's a great time to discuss your tax and financial planning, and we're hoping to deliver some real added value today, some takeaways that with the idea being you can consider to save some tax and make sure you've considered everything from a financial planning point of view. As always, the webinar today is brought to you by the Fusion Consulting Group, and we are a professional services group where we're not just siloed across taxation advice. We have the taxation division, accounting division, financial advisory division, and legal division, all in-house, collaborating, discussing your affairs on a regular basis to ensure you're efficient across everything you do. So delighted to be joined today by my colleagues. So some of you may remember Henry from the last webinar. So you'll be hearing from Henry shortly. And also delighted to introduce everyone to Chenji, who is our head of financial advisory at Fusion Financial, and you'll be hearing from him as well shortly. The idea is essentially to break down the session between tax, financial planning, and tax planning. So Henry will begin discussing some tax tips and some opportunities within taxation that you ought to consider before the end of the tax year. Here, hand over to Chenji, who will be looking over financial planning and opportunities to consider. And then I'll conclude to discuss some tax planning opportunities. We'll then commence a question and answer session. So if you do have questions throughout today's webinar, there is a chat facility where you can post your questions. It's likely we will leave them towards the end for the Q&A, and we'll be delighted to answer those. We're hoping today's session will last around 40 to 45 minutes, and we'll try and keep it as entertaining as possible. You'll see our contact details throughout the webinar today, so you can feel free to contact all of us. But as always, what we're offering is a joined up free consultation to anyone on today's webinar where they can discuss their tax and financial matters in greater detail with any combination of the three you see above as you wish. So do feel free to get in touch and take advantage of that. So without further ado, I'm going to hand you over to Henry, whom will begin the first part of today's webinar.
Thank you, Mitch. Thanks for the introduction, and hello, everyone. I hope everyone is doing well. I think it's a very fantastic time of year to be talking about some of maybe the pre-tax year-end planning opportunities available to us. So as you know, our tax year here in the UK ends on the 5th of April every year. So we have a fantastic opportunity. Maybe you filed your tax return on the 31st of January, or maybe you were one of the good ones and got it done earlier than that. But it's a fantastic opportunity now that the season for last year has been concluded. We can now start looking to the future, or rather the present, to think about what opportunities we have available to us. One of the biggest feedback points I get from my clients here at Fusion is that, why is my tax so high? And there are things we can do before the end of the year to potentially lower some exposure to tax. First one I want to talk about with you guys today is the annual exemption. So every year you get an amount tax-free that you can realize of chargeable gains without paying any tax on it. Currently, the amount is approximately £12,300 per year. However, going forward, there's going to be a reduction in this amount you can realize. So let's say you hold maybe a trading account or perhaps maybe some crypto, and you want to sell down on some of your investments, then you can do so in a tax efficient environment. Going forward though, from the 5th of, so after this tax year is concluded, from the 6th of April, this capital gains tax exemption is going to go down, and it's going to then go down again the following year. And each year, this annual exemption is on a use it or lose it basis. So if you are, say, you have maybe, let's say, £100,000 of uncrystallized gains, it makes sense to sell down on some of those assets to try and drip feed some of the gains out, so that you're not realizing £100,000 of capital gains in 1 year and are paying capital gains tax on the gain in excess of this annual exemption. And as well, because this annual exemption is going to be going down, you're going to have lesser opportunities in the future to realize any uncrystallized gains going forward. So make sure if you haven't sold anything, or maybe you have sold some, but you don't really realize what gain position you're at before the 5th of April, come have a conversation with us. We can look at that. We can review what the position is and see if we can do any opportunities there. So gifting properties, this is something that usually is quite a hot topic at the moment, particularly with individuals looking to help maybe with, let's say, their children or grandchildren get on the property market. Individuals look to gift property to their children. Just to note, whilst yes, usually you do get an exemption for selling assets that are your main residence, if you do not own, if for whatever reason you do not reside in the property and you gift a property, there may be some capital gains tax considerations there. Of course, gifting between spouses or civil partners doesn't result in any capital gains tax, but any gifts you do to anyone else, such as close family members, children, grandchildren, all of that will be done at market value. So regardless of the consideration given, there will be some capital gains tax considerations there. Each year, I would say it makes from switching over from capital gains tax, looking at inheritance tax, it usually makes sense to make sure, again, it's all about drip feeding wealth or drip feeding assets, so that you don't have 1 year where you have a sizable amount of capital gains, or 1 year which you make a large amount of gifts for inheritance tax purposes. So here in the UK, transfers to anyone, any individual, any gifts you do in excess of the small gift allowance are potentially exempt transfers in the UK, which just means if you live for 7 years, then there's no inheritance tax to pay. However, each year you get an annual exemption or annual exempt amount of £3,000. Again, there is some carryback potential, unlike the capital gains tax annual exemption. There's only 1 year carryback you can do. So that means each year you have £6,000 worth of annual exempt amount you can utilize each year, but that's for your total gifts. So that's not per individual, that's total gifts for the year. Again, so there's an element of use it or lose it with this. If you haven't used last year and you haven't used this year's, it makes sense to perhaps use it before the end of the tax year. Otherwise, if you wait next year, you will have this current year and next year's, but you've lost out on that prior year. So again, it's all about proactive thinking, looking at what your options, especially with tax. Usually the long view is always the best approach. So inheritance tax, of course, is maybe it's not necessarily the most fun tax to talk about, because you're talking about ultimately an individual who has passed away. But of course, it's something we all have to consider, especially when it comes to looking at from gifts from a tax perspective. But also, if you're looking, perhaps maybe you're thinking of gifting out your assets, you want to know what would happen if I passed away within those 7 years. So 7 years is a very vital time between gifts. Of course, when you are, say, looking to perhaps reduce your estate below the tax threshold for inheritance tax, again, it makes sense to start thinking proactively. Of course, ideally, you want to live more than 7 years, but if you don't, then again, there's opportunities there. and there's planning opportunities we can do if you live more than 3 years but less than 7 years. As you can see here from the slide, there's a tapering of the inheritance tax due. So the headline rate of 40% usually doesn't apply if you survive more than 3 years for that chargeable, or that they call it a failed pet when you die, and the potentially exempt transfer becomes subject to inheritance tax. So there's a multitude of options when it comes to gifting property. I mean, say if you don't have, let's say your children are under 18, or if you're looking at gifting to your grandchildren and they're under 18, there's options you could do to start the clock now and wait until either the individual is 18, or just waiting until whenever you feel they're ready to have the responsibility of owning a property. So say you own, let's say, £100,000 of cash, you want to give it to your child, but they're currently, let's say, 10 years old. You could look at trust options in terms of giving that money to the child without ultimately that child having that money in hand. So you retain an element of control over how that money is managed without, but doing it in a tax-friendly environment, so that you're starting that 7-year clock now. So by the time they're 18, that's not on your estate. There's no inheritance tax considerations, and your child is can have access to the money at your discretion. So fantastic opportunity there. If also as well, if you have any family heirlooms, or you're worried about assets being sold on your death to cover inheritance tax, it just means we can think about planning opportunities and moving things into trusts. That being said, trusts can be very complicated, and they're very specific tools for very specific purposes. So we just need to make sure that when you are involved in that sort of planning, that you're aware of the obligations as a trustee and what the potential tax exposure can be for that. Moving on slightly, again, another use it or lose it. Dividend allowance. So if you own a small business, or you own a company that pays out an annual dividend to the shareholders, either yourself, maybe yourself and your spouse, and all your children, you need to think about maybe making any using this tax-free allowance each year, so that you're utilizing the lowest tax, or rather you're paying out company profits in a tax-efficient way. Of course, this dividend allowance is going down from the 6th of April. So just because maybe you paid out £2,000 dividend this year doesn't mean you should do that next year. We can review it each year. So here at Fusion, if you say we're at, let's say, the end of March, you haven't paid out any dividends, we can look at your individual's say personal tax situation, and we can then advise you on what to pay out. In addition, next year, as you can see, these dividend allowances from the following year, 6th of April 2024, it's going down to £500 per year. So it's going to be incredibly, vanishingly beneficial for individuals to continue doing as they were previously. So tax rules change, and we need to make sure that we're on top of the current rules, and that we're thinking about the future as well as the past. Individuals, maybe if you opted out of your auto-enrollment pension, or if you're, say, someone who is a high earner at the moment, and you're on the cusp of being an additional rate taxpayer, tax rates are going up from the 6th of April 2023, which means we need to start thinking about how we can mitigate your taxable income for tax purposes. So say you have £100,000 of salary and you don't make any pension contributions, you're taxable fully on the 100,000. However, if you are on 100,000 and you want to make a £10,000 pre-tax pension contribution, your taxable income will only be £90,000. So there's very efficient tax planning we can do when it comes to pensions, or if it comes to, say, self-invested personal pension schemes, or if you want to maybe look at doing some gift aid. But what I will say is that don't sit on your hands. Make sure you're proactive, especially if you're on that border, the £125,000 mark, maybe even £150,000 mark. So we can look perhaps to lower that, so your tax bill doesn't go up. Again, things like pension contributions are incredibly beneficial for higher earners. And the reason is because you're on the highest marginal tax rate. So if we can lower your income, it means your potential tax savings is going into your pension, and you're better off in the long run. One of the most challenging tax hikes is going to be for corporation tax. So this is previously the UK had quite a comparatively low corporation tax of 19%. As if you own a company, or if you're maybe looking to set up a company, you probably already know. Going forward, this is going to increase to 25% for profits in excess of £250,000 per year. Of course, this raises a lot of questions. So if you say if you in the past maybe had a corporation to perhaps maybe do some consultancy from, after accounting for the now higher rate of corporation tax and the higher rate of dividend tax, it may be the case that, once after accounting for the tax hikes from the 6th of April 2023, you might be in a position where you're thinking, what's the point of having this corporate entity in the first place? Or maybe you're thinking there must be a more efficient thing we can do to lower those taxable profits, which we can look at later in the presentation. So I'm just going to hand over to my colleague Chenji. Chenji is our head of Fusion Financial. He's incredibly experienced when it comes to all things finance related, and I'm sure you're in very safe hands with him. But other than that, over to you, Chenji.
Thank you very much, Henry, for the brilliant tax education and the kind introduction. Hello, everyone. My name is Chenji. I'm the head of financial services here at Fusion Consulting Group. And having started a career in corporate finance, I have now, in the last couple of years, dealt in the space of personal finance, which enables me to essentially provide advice and add value to both individual clients and corporate clients who have financial planning requirements. And what I want to kind of first of all get into is that we are a full service wealth management company, IFA. We are whole of market. We're able to get access to products across the whole of market that's available. We deal with pensions, savings, investments, protection, business protection, estate planning, and more specialist planning services such as commercial finance, for example. And what I have personally realized in the industry and the professional advice industry of the past is that people tend to get fragmented advice. With Fusion, everything is under one umbrella. As Henry and Mitch have said, this 360 proposition we offer to our clients when Henry, Mitch, and the rest of the team makes a tax report, and with certain implementation strategies, such as, for example, pensions and investments, right? On another firm, they will pass it on to whoever, they will pass it on to the responsibility to the client to find whoever can implement this. With us at Fusion, right? I'm right next door. They will come here to ask me, right, okay, we prepared this tax report, this really great, brilliant strategy for our client. Chenji, can you help us implement? And I will say is, yes, sir, we can do. So the rest of my part of this webinar is just to actually show a bit of highlight a couple of the implementation bit that tax and financial services work together. So I'll touch a little bit about some last minute calculations. I know it's February. I know that April can seem very far away, but February is a short month. It'll pass in no time. In March, everybody is again worried about all the taxes. So do it now, and I promise you it'll be worth your time. So we'll touch a little bit about, first of all, pension contributions, the ISA allowance, the capital gains planning opportunities you're able to do, and just a couple of smart tips for setting yourself up for the new tax year. First of all, pension contributions. So here are some benefits of this, right? It is income tax relievable at the marginal rate. And what most people know that the rates of income tax in the UK is 0% based at within the personal allowance, 20% at the basic rate, higher rate is 40%, and additional rate is 45%. However, between 100,000 and 125,000, roughly speaking, you are actually at a tax trap, which is 60% tax. most people don't like to pay 60% tax. I don't think anyone would be happy to pay 60% tax. Hence, pension contributions is a really smart way as a tax strategy to reduce that potential trap that you are exposed to. So if you contribute money to a pension, you essentially widen your tax band. Second of all, if you're a business, you are able to gain full corporation tax relief on any pension contributions. Now, what this means is, especially given the corporation tax increase in the coming tax year, if you put £10,000 into a pension via the business, you get the full 25% of corporation tax relief from the business there. Furthermore, that money, when paid into a pension, there will be no dividend tax applicable. So essentially, you do save that double tax of both corporation tax and dividend tax, national insurance, income tax, everything. So it's essentially a very, very efficient way to save taxes. Now, what a lot of people don't know is the inheritance tax relief. So your pension assets as an individual are outside of your estate. And as many people know, we do have in the UK, we do have some allowances, but outside the inheritance tax allowances, right, there is a 40% tax applicable. And your pension assets don't count towards that. So what I've often advised my clients is, to do that smart calculation, right? If I have an inheritance tax liability, I have a business, if I take the cash from the business, right, and if something happens to me, there might be another 40% charge due. Can we put it into a pension and save inheritance tax this way? I do a lot with anywhere from business owners to doctors. It's a very smart planning for actually inheritance tax purposes as well. Now, it goes without saying that pensions will, all the assets within a pension grow free of capital gains tax, income tax, and dividend tax. Now, pensions, there's some really smart ways to do it. For example, in a SIP, you can own commercial property where rent payable into the SIP, into the pension is free of income tax. And again, any assets, traditional, stocks and shares or funds that you invest within the pensions grow free of capital gains tax and free of dividend tax as well. Extremely efficient. One thing to be careful of is that it is easy to over-contribute your pension. So there are certain rules about pension contributions, and it's not just the headline allowance is £40,000. However, it depends on, if you are an employed person, depends on your UK relevant earnings. However, for business owners, right, this becomes a bit more flexible as long as you can justify that the pensions are for the business purposes, which again can be confirmed by the accountant, Henry, Mitch. And following that, actually, a really smart way to plan about to use pension contributions to people's advantages is that you can contribute to a third party's pension. And that includes your children, includes your potential non-working spouse, it includes anybody. And you're able to get tax relief based on their tax rates. Now, what this means is a nice little opportunity, for example, for your children or non-working spouse or non-taxpayers, even though they have not paid a single penny to the taxman, you're able to provide them £3,600 per annum of pension contributions. That means actually in reality, you pay £2,880 per year and you get approximately £800 free from the government. So it's literally free money. Moving on to ISA allowances. So in the UK, as a UK resident, and you don't have to be a UK national, so you can be, for example, a citizen of another country, but you live in the UK, you are a UK tax resident, you are able to benefit from putting in £20,000 into a ISA allowance. Now, this is one of the most generous tax relievable allowances tax-free wrappers, what we call, in the world. In the US, you're able to put in $6,000 into a tax-free sort of ISA product like the UK ISA. And if you make over a certain amount of money, you're not able to use it at all. So in the UK, regardless how much you make, regardless of what the situation is, you are able to put £20,000 into an ISA. Now, everything that happens within the ISA is tax-free. So there is tax-free growth. There's no capital gains tax. There is no dividend tax. There's no interest, income tax on interest and anything else. However, do remember that your ISA is subject to the inheritance tax regime. So there are certain rules that you do have to be careful of in terms of what kind of, how many ISAs you can open. You can only open one type of ISA each tax year, and you can only contribute to one type of the particular ISA only into one provider, essentially. So again, speak to us if you have any questions about how to stay compliant with regards to your ISA contributions. Now, more recently, the last 2 years, the government has also encouraged to actually encouraging parents to save for their children, and they have increased the allowance for a junior ISA, upping it from, I believe it was about £4,000 into now it's now £9,000 per year that you can put into your underage children's ISA. If they're over 18, they benefit from the full £20,000 allowance. Now, what I briefly want to talk about is having the right pensions and investments. Now, what most people have, if you're an employed person working for a company, you will most likely be put into a default fund from in that pension. And 99% of employees in this country, at least from my personal data points, do not look at where their pensions are actually invested. Now, if you leave your garden just sitting there growing, there's going to be a lot of weed growing, right? If you take care of your garden, you'll have, a lovely garden. So speak to a professional about the appropriateness and where your pension funds are invested, and it can make a dramatic difference over the longer term. This graph essentially just shows the blue line is a popular fund that has done quite well historically. The black line in the bottom is, again, how the sector has on average performed. And then a red is just a default fund of a average pension provider as well. So you can see there are differences. If you take care of what's inside your pension, you can potentially gain the fruits in the longer term. Sorry. Now, this chart, right, we're also going to emphasize, especially these days after a dramatic year in the financial markets we've had in 2022, is that what's important is to have time in the market rather than trying to time the market every single time. You can see on this left side of this graph, this is what's happened since January 2022. You can see the top line, right, B, that's inflation. That's the UK Consumer Price Index. It's grown by 10.5%, right? And then the middle line, the green line, is what the average person will be getting into their interest in their savings account since January 2022, which is about 1%. And over the last year, the markets have not done quite well. The MSCI World, which is again a selection of the biggest companies in the world, has actually lost a slight bit of money of about -2%, right? However, if you look at this, if you now look at what's happened in the last 20 years since the turn of the century, right? You can then, on the right-hand side in the graph, the stock market, the selection of the biggest companies in the world would have given you, if you invested £100,000 at the turn of the century, we would now have £257,000. Now, inflation, the UK Consumer Index, during that time period, has gone up by approximately 76%. And if you kept your money in a savings account on a 90-day notice basis, right, you have only gotten a return of 55%, which means that the money has eroded in value. So inflation erodes the real value of money over time. That makes sense, doesn't it? And when people see risk, as in the left side of the chart, how the market has performed, right, over, certain every single month is up and down, up and down, up and down. The risk I see, and I try to help my clients understand, is that line between C and B on the right-hand side. If you're not in the market, this is the risk that you're missing out on. Now, moving on to capital gains planning, as Henry has mentioned, the capital gains exemption amount will continually decrease in the next tax year, from the following tax year onwards, to £6,000 next tax year and £3,000 the year after. What this means is that in this particular, before the 5th of April 2023, we're able to actually, there's some valuable benefits we can use in terms of the higher exemption amount of £12,300 that we can use before the end of the tax year. Now, what are the opportunities? First of all, a bed and breakfast. This is just a smart way of saying, you buy and repurchase your shares. So if you have made some, if you hold a portfolio of shares currently that's outside an ISA, and you've made actually a sizable gain over the last couple of years, right? It makes sense to use this strategy to crystallize some gains using the current higher amount of £12,300 in annual exemption amount. What you do have to be careful about is what's called the wash sale rule, which means that you can only counts as a repurchase after 30 days. So you have to be very careful about that. However, again, what I help advise my clients is that only applies to the same share. If we buy a share that's, again, in the similar industry that's complementary to each other, this one counts. There are actually some smart ways to stay in the market within those 30 days without triggering this 30-day wash sale rule. Another strategy is called the bet in ISA, and where, again, you crystallize your gains that you have using up some of the, or all of the £12,200 in the capital gains annual exemption, and then you put them into an ISA. Now, the benefit of this is there is no 30-day rule. So you can buy the exact same share back the same day without triggering that 30-day rule. Now, the con of this strategy is that obviously you are only limited to £20,000 per year. Now, we also have a lot of clients who are selling properties, and in this day and age, again, over the last decades, properties have been one of the biggest creators, have been the biggest element in wealth creation in the UK. However, it has also been one of the biggest wealth creation for the HMRC as well, especially moving forward with the inheritance tax aspects of it. And so people are thinking about actually sort of disposing of the property to crystallize some of the gains that they've made in the property market. Now, however, and now they realize I've got a very big capital gains tax bill, right? I don't want to pay it. Are there ways to actually prevent it? Are there ways to actually defer it? Yes, there are, right? And one of them is a strategy, using a CGT deferral via an enterprise investment scheme, which actually Mitch is going to talk to you about in a bit. Now, just lastly, just to touch a little bit about, setting yourself up successfully for the new year. If you have a business, it makes sense to start paying some life insurance from the business rather than from your personal, because again, if you pay, certain life insurance products such as a relevant life plan, such as other business protection plans, you're able to get full corporation tax relief. Again, in the following tax year is 25%. If you pay for the same life insurance personally, obviously the money that you use it to pay with, you've already paid 40% potentially income tax, 45%, or if you're 60% in that tax band. So again, can be very tax efficient way to pay for life insurance via your company if you have one. Get this done early, prior to the new tax year. Get it, as I said from the beginning of this, my session. Start now, right? Otherwise, you're gonna have to be running around like headless chickens to get everything done before the end of the tax year. And lastly, right, if we don't want to think about everything doing last minute, we can do a regular pension and ISA contributions so that we maximize all of our allowances alongside the year. And the benefit of being as well that when you invest regularly into the market, right, actually you lessen the risk that you have to be in the market. In professional terms, this is called pound cost averaging. And I'm sure there will be any questions on the financial side of things, and we welcome. We're going to open up the Q&A once Mitch has finished with his part. Now, without further ado, the man who needs no introduction, Mitch the Taxman.
Thanks, Chenji. Good debut. Really insightful stuff there. It's obviously generated quite a bit of comments and questions. So thank you for that. So we've been going now for nearly well over half an hour. So I'm just going to finish up on a couple of key points that I wanted to demonstrate and illustrate to you guys today. Obviously, Henry and Chenji have covered a lot. I want just to talk about intergenerational tax planning. Of course, when we're speaking about the end of the financial year, the end of the tax year, we're talking about taking advantages of capital gains allowances, taking advantage of today's tax rates. We know budgets are coming up. New budgets will be adhered to in the new financial year. So not only does it make sense to look at the tax planning ahead of the new financial year from a short-term perspective, we've got to look at it from a long-term perspective. So don't just think too short-termist. think about, right, okay, what can we do? How does the strategy look at from the long-term perspective as well? Particularly if you are a business owner, if you do have family, if you are concerned about next generation legacy planning, sheltering of assets. A lot of what we do is analysing the different effects of moving an asset from one individual to another, but outlining the different impact of taxes. So outlining the capital gains tax impact, outline once you've moved the properties into a trust, you know, what is the tax position of that? So what, it may be good from an inheritance tax mitigation perspective and a legacy bloodline protection, but what is the actual tax position on that? What's the tax position on the trust? So that's all things we're outlined to create the optimum plan, which on the most cases is where you have a family, they've got some assets, they might have a business. It's a hybrid model of advice, a hybrid model of strategic advice, which will potentially look at the sheltering of assets, corporate entities, trust work, pensions, ISAs. It's a very agile pieces of work, whereas, you know, traditional independent financial advisors may just be like, right, let's look at your pensions, let's look at your ISAs, but there needs to be nowadays more sophisticated type of planning, and that comes into the family structures, the family plan for you and your children. But also more and more we're now going in at the top level, if you like, which is the grandparents, and seeing what their strategies are. We're finding a lot of clients of a certain age haven't really looked at their inheritance tax planning. It's more the sort of middle tier ages of, you know, 35 to 55 who are thinking that, okay, well, we're going to receive that inheritance. Once we receive it, you know, how does that fit into our structure? And then obviously they want to save tax. They don't want 40% of their inheritance going to the tax man. So the agility of advice now is crucial. But the key point of today, of what I wanted to highlight over and above that point, is the tax efficient vehicles. Now, from a I can't comment from a financial perspective, but from a tax perspective, the HMRC approved tax efficient investment schemes is a fundamental way in which you can save taxation on an annual basis. And often it could be the case, particularly if you're at the additional rate of tax and even higher rate tax, in that you could end up either potentially paying tax to HMRC or investing some of that money to a tax efficient investment vehicle. Now, a tax efficient investment vehicle are HMRC approved investments. So that's the first point to say. These aren't some type of manufactured scheme with a view of tax avoidance. These are HMRC approved investments. And what they are is essentially investments into British companies. And the government have essentially incentivized individuals to invest in these entities and to encourage growth in the UK, and the investors would benefit from substantial tax relief. So I've highlighted the three main schemes on the screen, and if we start with what's called SEIS, which is the Seed Enterprise Investment Scheme. Now, as you can probably tell from the word seed, that is essentially new businesses that have been incorporated up to 2 years. So very new businesses. Obviously comes high risk if you're going to invest in these businesses. But often, you'll find is that there's fund providers who put together a collective amount of these businesses in order to spread the risk and then get them approved, something you can obviously speak to Chenji about. But from the seed enterprise investment scheme, what you can do is you can invest, and then let's use the example of £10,000, £10,000 into an SCIS qualifying investment, and automatically you would get 50% income tax relief. And this comes as a pure tax reducer. So what I mean by that is if you invest £10,000, you would get £5,000 as a tax reducer against your income tax liability for that year, or you can go back a year. So that's quite attractive from a tax relief point of view. You'd also benefit from other reliefs. All of these basically qualify for these types of reliefs, such as if you hold the shares for longer than 3 years and they make a profit, then you can benefit from capital gains tax relief, i.e. no capital gains tax. There's inheritance tax relief, i.e. they sit outside your estate, the value. And also what's interesting, there's elements of loss relief, so that if the investment became negligible and went wrong, you can claim an element of loss relief. So when it comes to risk on the investments are high risk and you need to seek independent financial advice. But equally, when you weigh up all those tax benefits and the fact you get loss relief, then they're worth considering if you've got the available cash, or even to diversify your investment strategies. What's also very interesting about the SEIS is that, unlike EIS and VCTs, which I'll quickly go over later, is that you can be connected to the company up to a maximum shareholding of 30% connected. So what this means is that if you had a business idea with your colleagues or friends or some wider family that's not, first line wife, dad, etc., you can create your own company. And you may have 15% of the company and your friends accordingly, and you can invest in your own company qualifying for SEIS and obtain the relief. So there's clever bits of planning, sophisticated type tax strategies that can be done with the SEIS over and above an investment. We then come on to EIS. So EIS works in a similar way, but it's a 30% income tax relief. But then obviously not for startups, therefore established businesses in the UK, a lot of businesses you would have heard of that you can invest in. Again, there's specific funds out there, such as a company called Octopus, who put together a collection of fast growth companies that are doing well that you can spread the risk. So that's EIS. So, in terms of the risk, slightly lower risk than a startup and SEIS, and hence the tax relief at 30% of an income tax relief. Chenji mentioned capital gains tax mitigation. Capital gains tax is one of those taxes which are difficult to mitigate once the event has happened. In fact, one of the only places in which you can mitigate the capital gains tax, and it's not really a mitigation, it's called a deferral, is via investing in the EIS. So you can invest in the EIS, so you can invest the gain into the EIS, and depending on the amount you put in, you can essentially invest that gain into the EIS, defer the gain, so you don't pay the capital gains tax in that year. You essentially invest in the EIS, and then you defer for when you eventually sell the shares in your EIS scheme. The idea is that you never pay the capital gains tax because you continuously adopt an EIS strategy, and then what happens on your death, then it will essentially go away. So EIS deferral relief, capital gains tax relief, could be an option from a capital gains tax perspective. And then VCTs essentially stands for venture capital trusts. similar to EIS, you can get the income tax relief. Also, you can get dividends and get some tax-free amounts on the dividends as well. They're often seen as slightly more of the safer type of way to invest as an ongoing strategy. But the point is that you don't know until you know, and these are good investments from a tax perspective to consider when you do have tax liabilities coming up. But as mentioned, of course, high risk, have to seek independent financial advice. So 45 minutes is up. We've gone a bit over. I'm going to blame, who should I blame for that? No, it's fine. So we mentioned we are offering a free consultation. So we love helping new clients, existing clients, people who have been stuck with their old school accountants or IFAs, and they're looking for more of an energetic, sophisticated type of strategy. We're here ready to help you and your family achieve optimum efficiencies. So we're going to hang around for around five minutes to go through some of your questions. So thank you for sending in your questions. So I mean, Henry, I guess you've been looking at a few. So let me just look at what we've got here. So we've got Amit, who has sent a few questions in. So should we start with those? Chenji or Henry, whoever wants to answer is fine.
Yeah, I'll take it.
Okay, so Henry can answer those. So we've got the pension at 20% relief added by my company provider. I pay 42% tax. Can I claim the additional 22% via HMRC using self-assessment?
Well, Amit, these are really intuitive questions, and I've got to say this is exactly the kind of planning we do for our clients. But just to give you a bit of a summary, so I'll answer the question about income tax first, and then we can look at looking at the national insurance side after that. But when it comes to pension contributions, you need to bear in mind that there are two things we're considering here. One is a pre-tax contribution to a scheme, and when that happens, it essentially means you're not paying income tax and you're not paying national insurance on those gross pension contributions. So let's say you have £100,000 of a profit for the year and you want to make a pension contribution. You could put in £20,000, for example, and your taxable profits after that is only £20,000. So it's great for two reasons. One is that the 20,000 you make to the pension scheme, you pay that in, so there was never any corporation tax to pay on that profit, and there's no income tax to pay on the distribution. So you make that contribution into the scheme, so your taxable profit's now 80%. And let's say you draw a salary, rather than take the salary out directly, you'll pay national insurance contributions on that. And that's both say it's your company, you're paying employers and employees national insurance contribution on any salary that you subsequently want to put into your pension. So it cuts out the middleman, and it results in significant tax savings from your point of view, because you have, let's say, pre-tax, you have profits you want to put into a pension, you could put that in, and it is quite efficient. The one thing to bear in mind is that if you, let's say you did draw a salary and you wanted to make, and this kind of leads on to Jay's question about SIPs. A SIP is a self-invested personal pension scheme. So that's, you have all SIPs are pensions, but not all pensions are SIPs. So when you have, let's say, a workplace pension scheme with Aviva or whoever, you can pay, if you're paying post-tax salary into a pension scheme, you can get the top up from the government in the form of through your self-assessment or just the tax relief there. But bear in mind, you'll pay national insurance, which you can't claim back from the government. So this is only to do with income tax that you paid upon the receipt of that money. But I hope that answers it. But I'll tell you what, if you have questions about the overall strategy, please give us a call and we could talk about that. But those are some really intuitive questions.
Thanks.
Just want to Yeah, just want to quickly add something on the national insurance bit. So the national insurance savings on pensions is actually a smart way for both an employer and an employee. Because so I help a lot of employees, right, who are highly paid, to do what's called a salary sacrifice, in which way, with their companies, in which case they get actually not only relief on the employee national insurance, but oftentimes they get added on top the savings that the employer has had on the employer national insurance. Now, I also act for companies who have, again, a number of employees and key employees they want to retain, and using a salary sacrifice scheme for them is a key way to increase a benefit for the employee without incurring any extra costs, because essentially, via purely a national insurance savings. So if you want to explore, either because you're a business, you're owner of a business with employees you want to, get increase the benefits for without having to pay actually a lot of money, or you are an employee wishing to discuss salary sacrifice schemes, right, chat to me. I'm happy to give you some advice on that.
Okay, thanks, guys. We've probably got room for a couple more. So I'll just pick the one about EIS, and then you guys can pick one more to finish off. So essentially the way it works is that if you hold the shares for 3 years, so you need to hold the shares for 3 years, and then when you sell the shares, that's where the capital gains tax relief will come in terms of the profits on the sale of the shares. It's not if you are moving again in and then you hold those shares for 3 years, that deferral doesn't get mitigated. It's essentially there's two different types of reliefs interacting there. So guys, do you want to pick one more question to finish off, and then we can conclude?
On that one as well, really quick, Shakil. So the investment itself, the EIS investment, will be capital gains tax free if you hold it for more than 3 years. So obviously the deferral you still have to pay at one point, but the investment itself will be tax free after 3 years in terms of capital gains.
Okay. All right. So I think we'll look to conclude there. Obviously, if anyone has any specific personal related questions that they didn't feel comfortable to put on the screen, then you've got all of our email addresses on screen, and we'd be happy to answer some questions. Also, we'd be very delighted to meet with you and speak with you to talk about your matters in greater detail to see if we can help. We'll be running, as you know, a series of webinars. So our next webinar on the corporate side of our business will be in a couple of weeks, and you'll see the three of us back probably the first week in March for our final tax and financial update before the start of the new tax year. I'd like to thank you all for investing your time this morning, and for those who are watching on replay for investing the time to gain some knowledge from us. Thank you to Henry and Chenji for your time and words of wisdom as well. And we look forward to seeing you all again.
Thank you, and thank you for your time.